Welcome to This Is Money podcast. I'm Georgie Frost, and joining me and Simon Lambert today is Helen Crane. And coming up, mortgage mayhem, savings frenzy. What on earth is going on? Lenders are continuing to pull deals left, right and centre and rapidly hiking rates. It's starting to look a lot like the panic we saw in the wake of the disastrous mini-budget last year. Is it? So what should you do if you need a mortgage? Will house prices really fall 35%? Is buy-to-let worth it anymore? And what will happen to renters? On the flip side, is this a prime time to grab a savings deal, or should you wait for better rates? What does it all mean for our money, for the economy? Are we all doomed? Wonders Simon. Don't forget you stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app.
Don't forget, you can stay on top of what's going on in the markets by tuning in to the Digest and Invest podcast by eToro. Go to your regular podcast platform and listen on the go. Digest and Invest by eToro, the podcast for those interested in trading and investing.
But first, Nationwide became the latest lender this week to bump up their mortgage rates, while HSBC pulled their deals for the second time as borrowers and the market brace for a 13th successive Bank of England interest rate rise. According to Money Facts, the average rate on a new 2-year fix is now at 5.92%. The typical rate on a new 5-year fix is up to 5.56%. The seemingly unrelenting rise going on at the moment is adding to pressure on home buyers and those whose fixed-term deals are expiring. It's also starting to look a lot like a rerun of the chaotic fallout from last autumn's calamitous mini-budget. So what on earth is going on, and what should you do? Simon, Helen, welcome. Simon, what's happening? Why is it happening?
There is something of a mortgage mini panic going on. Arguably, you could say it's shifted from mini panic to major panic, I think. It is absolute carnage. There is no other way of describing it. It is 100% almost exactly reminiscent of what was going on after Kwasi Kwarteng and Liz Truss's ill-fated mini-budget, where all of a sudden there was an expectation that the Bank of England was going to have to raise interest rates much more than was thought, at which point gilt yields rose substantially as well, because markets said, well, hey, look, you want us to lend you money, you're going to have to pay us more interest. And there was the expectation that rates were going to go up by more than originally thought. That fed through to mortgage pricing. Swap rates is what influences mortgage pricing. Swap rates are based on what the market thinks is going to happen to the path of interest rates. And you saw lenders pulling mortgage deals, repricing them at higher levels. And they were doing that rapidly. Mortgages were not sitting around. Product numbers on offer were dwindling. We talk about these average rates that people are facing. And currently, the average 2-year fix today, as we're recording this podcast, has reached 5.98%. That is pretty high when you were looking at, rates in the twos not so long ago. But that's if you can get the average 2-year fix. It's a possibility that you call your broker and your broker's completely flat out and they've got lenders pulling mortgages left, right and centre and you can't even get the mortgage. So people are understandably very concerned. It's a major concern for anybody who has to remortgage right now. But what's interesting about it is that it sort of only goes back just about a month or so. And what appeared to be the trigger for this was the last set of inflation numbers, which showed inflation had actually fallen below 10%. It had fallen to 8.7%, which is great news, except core inflation, which is the inflation number underlying the inflation number, strips out volatile stuff, was rising and not only has remained stubbornly high, but was rising. And in fact, it had hit a recent peak. At which point everyone went, oh, hang on a minute. The UK's inflation problem is not going away. You've then had other bits of data that have fed into this. There are real concerns over food price inflation, looking across at other countries whose inflation is falling much faster than ours is. Why isn't ours falling as fast? And this sent the mortgage market into a bit of panic, triggered off the back of this expectation that rates were going to go up. So the Bank of England, we were thinking not so long ago, we talked about the Bank of England stopping maybe now at 4.5%. That was it. Wasn't going to go any further. and now we're talking about it could go to 6%. That is a dramatic shift in expectations, and you've got the mortgage market running after those expectations, trying to keep up. And this week's bit of bad news was that wages are going up. The thing is, though, we know wages are going up. Wages have been going up for some time, and actually wages are falling in real terms. So was that merit? Did that merit the panic, all the worry about wage price spirals and so on? And what the Bank of England's doing with all these rate rises is trying to crack down on inflation in the future. It's not trying to crack down on the inflation that we've already seen. So that 8.7%, that's backward looking. That's what's happened to prices since last year. You can't do anything about that now. What it wants to do is try to crack down on inflationary expectations and prices, and businesses thinking they can raise their prices, and suppliers raising prices, and people asking for bigger wages, and all of that kind of stuff that's coming over the next year, so they can get that number down to 2%. And it looks like the mortgage market is once again running way ahead of the Bank of England, and that's leading to the current mayhem. And it is, I think, mayhem is possibly a word overused in journalism, but I think this is mayhem.
I'm just loving how much we're smashing the dictionary right now to describe this. We've got mayhem, carnage, calamitous, disastrous, chaotic, ill-fated. That's just mainly the mini budget from last year,
which it should be noted. Just before you say
that's
are very different words to the ones that we were reassured by Mark Carney when rates went up. Gradual and limited. Say it in your best Canadian George Clooney central banker voice. Gradual and limited. Not mayhem and carnage. So we were promised gradual and limited. We got mayhem and carnage.
We did indeed. But Helen, and we'll talk about Mark Carney in a short while because he's sort of waded into the debate as well. But is this a mini panic that will pass, similar-ish to what we saw last autumn, or are rates likely to stay high?
I think the current panic has to subside at some point. I mean, you can't just stay in a constant state of panic all the time. I mean, that would be absolute kind of madness.
It kind of feels like we have been for the last 3 years, though.
It does.
I don't know.
It does. And that was what I was going to say, actually. I do think it feels like for the last 2 or 3 years, it feels like we've been kind of teetering on the brink of something. You know, we had the pandemic and everyone was saying, you know, this is going to crash the economy, house prices are going to crash, and it didn't. Then we had inflation starting to spike, and it was, this is the thing that's going to tip it over, and it didn't. Then we had the mini budget blip, and that seemed to be a thing that really kind of turned things around. That's now been sort of compounded by these worse than expected inflation figures. I think in a way this is kind of the culmination of something that's been going on for quite a while. You know, mortgage rates did have to rise at some point. They got ridiculously low. If we think back to a couple of years ago, there were rates below 1%. Like, of course that couldn't last forever. But I do think, you know, listening to brokers and sort of property and mortgage experts, they've been saying for a while that rates are probably going to stay on average about 5% for the next couple of years. And that was before this escalation that we've had in the last couple of weeks. So I think we're definitely not going back to sort of sub 2% rates anytime soon, unfortunately. As for how long this kind of episode of panic and, you know, sort of seeing lenders raising rates every day goes on, I mean, it's difficult to tell. Will it end when we have some more optimistic figures on inflation? I mean, maybe you would hope so, but the thing is that lenders, as we said, are kind of can be uber cautious, and they'll react quite strongly to any bit of sort of negative news. So it will take a while for the rates to come down. You know, mortgage rates don't just come down. You know, the lenders don't step out of it; they'll bring them down gradually. So yeah, I think unfortunately this is something that's going to go on for quite some time.
What's the wider fallout of this? Before we get into specifics, Simon, about what people can do, what do you expect to happen in the sort of short and medium term, I guess? I mean, you've spoken to a couple of experts, one of them suggesting on your website house prices could fall 35% by 2025. We hear a lot about house price fall predictions that have yet to come to pass. Is this likely?
I don't envisage any scenario where this doesn't make house prices cheaper. or bring down house prices, because ultimately most people rely on a mortgage to buy a home. So you've got, if you break the population down, you've got about 1/3 of people are mortgaged homeowners, and then you've got 1/3 of people are unmortgaged homeowners. It tends to be the older generation who've paid off their mortgages, and then you've got 1/3 of people who are renting. Now, if you take the 1/3 of people who are renting, there's a slice of those who want to buy and would buy if they could do. You take the people who own a home, obviously, they already own one, but quite a lot of them would want to move. If you take the ones who own a home unmortgaged, most of them probably aren't planning on moving at all. So the vast majority of people, I think it's safe to say, need a mortgage to buy. Cash buyers make up about 30% of the market. People are always quite surprised by that. If the cost of borrowing a mortgage has gone up, then you can borrow less money. It's just logical. So if you take an example where somebody could have bought a property with a fix at 1.5%, they would have been able to borrow, a certain amount of money up to the monthly payments that they can afford. And that tends to define how much people can borrow. It's the monthly payments. So the deposit, the value of the property, and the monthly payments they can afford. Now, the deposit theoretically hasn't changed in the scenario we're in. But the monthly payments have changed substantially. And so whereas your £1,500 a month you could spend on a mortgage 2 years ago could have got you X, it will now only get you X minus quite a bit. So you're not able to pay what you could for the property anymore, unless you've either had a huge pay increase, so therefore you can afford more every month. But most people haven't had huge pay increases, and they've also had all of their other bills going up at the same time. Or you can find substantially more money to go into your deposit. Most people can't find substantially more money to go to their deposit. They're usually buying with as big a deposit as they possibly can. They've scraped together all of the cash they can from all of the different sources. So I don't really see how this isn't going to drag down house prices. And that's not necessarily a bad thing. I mean, we were looking at a scenario where property prices have gone up about 20%, 20 to 25%, depending on what index you look at, since the start of the pandemic. And house prices were already really expensive at the start of the pandemic. So they got really expensive plus 25%, which isn't good news. And you can trace almost all of the economic problems we have in the UK back to the problem of too high house prices. There's been, when you think about all of the gains that people have had in terms of their material existence, that they should feel much wealthier than they do. Often they don't, because they're pouring more and more money into this bottomless pit marked putting a roof over their heads. So lower house prices would be a good thing, but not for anybody who's bought recently at a higher house price. And I think, the recalibration towards a world of higher interest rates and lower house prices back to a scenario where they weren't such a sky-high multiple of wages is a good thing. I don't think it's a good thing for it to be happening like it's happening now, because an entire generation is basically being massively shafted. And at the back end of this, what happens is, due to the colossal rise in mortgage, they bought really expensive properties with really big mortgages at very low interest rates. Now interest rates have gone up massively, which is going to seriously hamper their ability to pay those mortgages and their standard of living and their cost of living. And they're going to end up paying, a lot more money, tens of thousands, maybe hundreds of thousands of pounds extra interest to the bank. So I think the impact of this is quite substantial. Even if this just went away and in a year's time, panic over, rates are back at 2 or 3%, there'd still be a load of people who fixed now and ended up paying an absolute fortune. And I think there is a growing sense of annoyance and anger at this. It exacerbates the intergenerational divide, as we've talked about before. On one hand, you've got people being hammered by this who've managed to get themselves onto the property ladder, and all of a sudden they're seeing that staring down the barrel of £300, £500 a month more. You've got people who are hoping to buy, who had just got themselves into a position where they thought they might be able to buy, and now they can't because mortgage rates have rocketed. But the good news for them is that if house prices come down and they're still sitting on the same deposit and everything, then that does them a favour. And then you've got some of the older generation who are either, they might be seeing the pain their children's generation are going through, They might have a lot of sympathy, or they might have no sympathy at all and start banging on about, well, we had double-digit interest rates. To which the answer is basically yes, but property prices were much lower by comparison to wages. And actually, if you look at the data and you adjust for property prices, what you will find is this is as painful, if not more painful, than what happened in the late 80s and early 1990s. But sometimes people don't want to listen to that, to the logical argument and look at the data. They just want to give their kind of gut reaction to something, and so
surely not, Simon.
It's it's causing a problem. It's causing a problem already for the government. There's talk of like, well, the government's going to need to step in. It's going to have to help people with their mortgages. It's like, I mean, is it really? Are we going to? Are we now going to start paying people's mortgages?
We've got to a weird situation where anything like this happens. It's like, get the government to step in, get price caps for food, get price caps for energy, get price caps for rent, pay people's mortgages. And
just to be clear, the Bank of England is deliberately raising interest rates to try and crack down on inflation. So it's pulling a lever, a blunt lever, all the same, which is probably going to drive, it's pulling it so hard that it's now happy to yank it all the way down so we go into recession. If the government starts paying people's mortgages, the Bank of England raising interest rates will have much less impact. So the Bank of England would need to keep raising interest rates even higher because the impact is being, kind of softened by the government paying people's mortgages. And whose mortgages do we decide to pay? Everyone's?
Indeed.
Just somebody's? I mean, I don't think the government's going to stop paying people's mortgages, but this is a real, really, really big problem. And it's also a big economic problem because it's sucking a huge amount of money out of the economy. And we had this conversation a number of times in recent months where we've said there's kind of been this view that maybe we've got away with these rapid rate rises, and perhaps actually we haven't yet. And I think this is the point where the we've got away with this scenario has disappeared down the road, and we're staring down the barrel of perhaps no, we haven't yet.
Right. Helen, let's get practical, though. If you are staring down the barrel of the end of your fix, and you managed to get one very cheap 2 years ago, and you're looking now at hundreds of pounds of extra payments a month, what on earth should you be doing? What do you do if you are thinking of buying a home for the first time? Give us some practical advice.
Yeah, I do really feel for people in this situation, especially as Simon was saying, you get slightly older people sort of saying, oh, well, people shouldn't have overstretched themselves so much on buying a house if they didn't want to end up with these high mortgage rates. But, that's the situation we've been given. You can't, if that's what mortgage rates have been, that's what you have to do if you want to buy a house. So it's, I don't think people have necessarily been kind of careless in this sort of situation that they've found themselves in. If you are coming up to a remortgage and, you are seeing that it's going to be a lot higher, I think the first thing is to work out the specifics of exactly how much more you might be needing to pay. So if you go to our website, we have a mortgage payment calculator, so you can key in your current interest rate and the sort of interest rate you might be going on to, and work out exactly how much more that will cost you each month, which it's just good to know, if there's ways you can budget to deal with that. You can start thinking about maybe how that'd be possible. I was just definitely talking to your mortgage lender and also to a broker. So if you are coming to remortgage, don't necessarily think, oh, I'll just stick with the same lender, because you might well be able to find a better rate elsewhere. Talking to a broker, they'll be able to see the best rates you can get. Even if they are a lot higher, you might be able to save quite a bit by switching lenders. So that's definitely something to look into. Also, if you do think it's going to be a real struggle, chat to your lender. They might be able to help. That they are supposed to help people who look like they're really going to be struggling. They might be able to do sort of payment plan or offer you slightly different terms, perhaps extend your mortgage term, which not an ideal thing to do, but it can help to bring your monthly payments down in the short term. So don't bury your head in the sand. Talk to your lender, talk to your broker, and kind of see what the situation is. If you're looking to buy your first home, I've been talking to some friends about this recently, potential first home buyers who may be getting close to having the deposit they need. And there's, what do we do? This situation of panic is obviously scaring them. They don't know much about buying a house. They've never kind of got a mortgage before, and they're just thinking, what on earth is happening? I would suggest the same thing, chat to your broker, work out your options. also, I mean, it really depends on your individual situation. You know, different people are going to have different kind of priorities. You know, you've got a deposit. Some people just want to buy a house and, you know, get it done. I do think maybe holding off for a while might not be the worst idea, even just for a few weeks to kind of see where all this settles. You know, you'd really kick yourself if you fixed it, you know, 6% today, and then in a couple of months' time, you saw a rate that was, you know, 5% or substantially less. So perhaps consider holding off for a while, even though that's, you know, that's not going to be possible for everyone.
Good advice. Thank you very much, Helen. That's it for part one.
I'm joined now by Sam North of eToro for our weekly look at what's been going on the markets. Sam, how's the past week been?
So, yeah, it was a big week. The Bulls versus the Bears, some really big macro events. And the winner, well, pretty comprehensively, it was the Bulls. Inflation on Tuesday from the US came down. And then a day later, the Fed kept rates unchanged and the market moved higher, despite some hawkish comments. The S&P 500 trades above 4,400 for the first time since April 2022. Elsewhere, China lowered rates. The ECB raised them, which kind of just shows how far China are from the other part of the world. The UK data was pretty strong, which is worrying people that inflation will stay sticky and interest rates will have to go higher than we're already expecting. So whilst the pound reached a multi-month high, that in reality is probably the only silver lining that we see. One other interesting thing to mention is that it does look like Qatari's bid to buy Manchester United for around $6 billion is pretty much done. One to watch next week, perhaps.
What have we got to look forward to next week?
So, yeah, next week, I mean, the big week is out the way. We only have half a month left now for the second quarter, but there still is a few things for us to keep an eye on. And from a UK perspective, it's important. Hopefully, we see inflation come lower, but if not, it's just going to add more fuel to the fire. That comes out on Wednesday. And then a day later, we have the latest Bank of England announcement before also having retail sales and PMI data on the Friday. I worry that this time next week, it's not going to look too great for the UK, but fingers crossed I am wrong. I have been before. Other than that, we have other policy announcements from China, Switzerland and Norway, which are worth checking in on as well. We also have global PMIs, not just the UK PMIs on the Friday, and also Japanese inflation data, which has been low for quite some time. Do we start to see a pickup there? Maybe one to watch. Another busy one, and fingers crossed this time next week for the UK, it looks a little bit better than it does right now.
Thank you very much. That's Sam North from eToro.
Thank you, Lee.
Welcome back. A headline in a rival paper this week. Death knell for buy-to-let as mortgage rates near 7%. This after NatWest bumped its prices, which could add more than £300 a month to a typical landlord's loan. So what impact will this have on the rental market? We're already seeing prices rise very substantially in that area. With price rises like this to mortgage rates for landlords, you would assume, Helen, as a renter, they'd have to pass it on.
Yeah, I mean, of course, landlords will almost always pass on any increases in their costs to their tenants. That said, though, the majority of landlords don't actually own their properties with a mortgage. Most own their properties outright. So technically, they don't have that increase in mortgage costs. I'm not saying landlords are unscrupulous, but if they kind of see properties rents kind of going up in the area, they probably are going to still increase them up to that kind of market level. So it's sort of a situation where landlords that do have mortgages will pass on those costs, and then other landlords will say, well, you know, another landlord in his block of flats has put his rent up by £200 a month, so, you know, why wouldn't I do that? That's what people are having to pay. So yeah, I mean, increasing mortgage costs generally will lead to landlords putting their rents up. The other thing that might not sound too bad to tenants, but actually does end up having an effect on them, is that some landlords might decide to leave the rental market or sell some of their properties, and they're kind of being hammered by these higher costs if they do have a mortgage. And then there's this kind of continuing sort of trend over the last few years of more regulation for landlords, higher taxes and things like that. So it's becoming less attractive to be a landlord. And if they do sell, that means that ultimately there's going to be fewer rental properties on the market, which drives up competition for those that are available. And that unfortunately will also probably push up rents. So it's a bit of a kind of lose-lose situation for tenants. But yeah, landlords also not feeling very happy.
No, indeed. I mean, Simon and Helen there said that landlords will pass on costs. £300 a month is a huge amount if you do have, of course, a mortgage. And there are lots of individual, unprofessional, I don't mean that in a negative way, I mean perhaps accidental landlords in the market that may look at this and think, with all the tax changes, with the new laws that are coming in that are designed to protect tenants, with interest rates rising, what on earth is the point? We're already seeing, are we not, huge swathes leave?
We are, but perhaps not as much as is sometimes reported. I think there are a number of factors at play here, and some of the factors are not just the costs that they are facing, which have gone up. So mortgage costs have gone up, but also just the costs of being a landlord have gone up. There's the EPC stuff that's coming in. They've got to make their properties more energy efficient. In some cases, spending thousands of pounds to do so, and in some cases, staring down the barrel of it, looking like it's absolutely impossible to make some of those properties as energy efficient as they're meant to be. There's lots more regulation. There has been a squeeze on them. They're paying more tax. And often people don't look at these things entirely logically. They look at how they're paying more tax and they go, well, it's not worth me doing it. I might as well give up. I might as well sell up. They don't look at the fact that they're actually still making a profit. But there comes a point where the profit they're making might not be worth doing. But when I was saying that some of this is kind of maybe over-exaggerated, how many are leaving, there are still lots of them who are sitting on major capital gains and are still making money every month and thinking, well, do you know what? It's harder than it was, but I might as well stick with it, because what else am I going to do with the money? There's that Tina. There is no alternative, which was the argument for why a lot of money went into the stock market through the low interest rates era. Now, Tina is done with and finished. I'm not just talking about Tina Turner, God better. But there is an alternative now, and the alternative is putting your money into cash. But a lot of landlords are looking at that and going, well, if I take all of this money and put it into cash, I'm going to get taxed on my cash savings anyway. It's way too much money to put into an ISA. And I don't want to invest it because I'm worried about the stock market, even though actually the figures show the stock market has delivered better returns over the long term. So I might as well just leave it. I might as well just stick with the property. And we should never underestimate, as we've said before many times, the kind of people's propensity to take the easiest option. So to take the path of least resistance. And the path of least resistance for many landlords is just to stay put. Actually, ironically, one of the things that puts them off selling is the tax, the capital gains tax that they would pay on their profits, even though, as I said, they would still be making big profits. So I don't know, but you could definitely see how there's not going to be many new people coming into buy-to-let until you see a step down in property prices and all of a sudden yields start to look much better, and then you will get the interest. You will get the interest again from people.
Right, so not the death knell, you think?
No, not the death knell, just not quite the raging party that it once was.
Fair
it's maybe more of a small gathering of friends having a good time rather than Jack Grealish on his third night out in a row.
Touche. All right, then. On the flip side of all of this, savings rates are looking healthier than they have in a long time, but not all. MPs on the Commons Treasury Committee have told Britain's biggest banks they need to up their game and stop fobbing off millions of loyal customers with measly savings rates. Despite those 12 rises, taking the base rate up to 4.5%, will we get a 13th soon? MPs are investigating why many leading banks are still offering easy access savings accounts paying less than 1%, and in some cases as little as 0.25%, or as Simon likes to call them, insult accounts. Firstly, Helen, what can we get out there now? The best ones. Let's start with the positives.
Yeah, so we had this week what our savings reporter Ed Magnus has termed a 24-hour savings frenzy. Yeah, it caused a lot of excitement in the This Is Money office. So in this 24-hour period, there are a few really, really tasty looking savings accounts launched. So Smart Save Bank, number one, they launched the top 1 year fixed rate savings account. That is paying, 1 second, let me just double check, 5.41% on a 1 year fixed savings account. So pretty decent. We also had that Investec launched a table topping 5.35% rate, Ryan 5.36%. So essentially just upping each other, particularly on these 1 year fixes. So some really good accounts there. However, as you mentioned, none of these still come anywhere near beating inflation. That's a rub. Savings rates are looking better than they've looked in many, many years, but inflation is also much higher. So you're still effectively losing money on your cash in real terms.
Yeah, not just inflation, banks not passing on those rates, Simon. Why are MPs investigating this? Do they actually need to pass it on? I mean, they're businesses after all, no?
They are businesses after all. But as Helen said, whilst savings rates in general, we have seen Manchester City level of partying this week from the savings market. In fact, savings rises, they looked at Jack Grealish and they went, lightweight, mate, we're going all week. Yeah. You're stopping 3 days in. But that's not true everywhere. The big banks are still very, very slow to pass on these rates. And if you dig into their figures, you will see that their net interest margins are rising. This is the measure of how much money a bank makes between what it pays savers and what it charges on loans, not just mortgages, all loans. And they're getting wider. They're doing very well. They're making pots of cash. Our man, Sam Barker, did an excellent investigation into the net interest margins of big banks when they all had their profits out a few months back, and demonstrated quite how much more they're making. And they will continue to make more. Rising rates are good for banks. And actually, I have an element of sympathy with some of them at the moment, because they're being forced to pull rates because they've got two problems. One, they need to fund the mortgages, and they can either do that through money from savers, or they can do it via the money markets. Money from savers is not as simple as just taking money in and lending it out, but they need to get that money onto their balance sheets in order to expand their lending. And money from savers is a relatively stable way of getting money in, but they're racing to pull this money in. If you look at these smaller banks, they're racing to pull this money in. Money from the money markets, as we talked about earlier in the podcast, they've gone completely nuts at the moment. So there's a problem there. So they're worried about being caught out, mispricing their mortgages. And you're seeing some of them race to pull in savers, but they don't have to race quite as hard to pull in savers as they do to bump up mortgage rates. And some of these banks are just bumping up mortgage rates because they want to throttle the business, because they can't deal with the business. Even if they have got loads of funding, even if you're HSBC or Nationwide, you have got pots of cash. But if you sit around with the lowest mortgage rate on the market, you're going to get absolutely inundated. So they're having to pull deals and reprice them in order to just stop themselves being inundated. But as they reprice them, they are definitely not raising savings rates at the same pace. So, Nationwide, I think, is on its second mortgage repricing of the week. HSBC might be on its 39th or something like that. But they haven't, HSBC and Nationwide haven't been raising savings rates that many times this week. It's the smaller banks who are doing it, the smaller banks trying to pull in money. So there is a scenario where, even though rates look much, much better than they were, MPs have a point. But they are businesses. They are there to make money. You do want your banks to make money, but you don't want them to rip you off. And they only have themselves to blame.
Yeah.
That's all I can say. No, the banks, not
the
people.
Banks, right,
people
sorry.
No, people have the banks to blame.
Right, okay.
And the banks only have themselves to blame. And MPs like to blame everything apart from themselves. But many of them may also not be entirely faultless.
I mean, that's true, but you could sit around and moan about it, getting your 0.25%, or you could do something about it. So when it comes to that, that's really on us, isn't it?
That is on us. But sometimes it's not as easy as it could be, but sometimes it's super, 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 super duper easy. So, I could tell you about Boyce. and his travails this week.
Tell me about Lee.
So Lee wanted an easy access savings account, something easy, something simple. And he banks with First Direct, and he spotted, and he had a look on their app to see what was available. Just a really kind of rubbishy instant access deal, paying, I think it's like 1.3 or 1.5%. It's not great, basically. No. Then he thought, oh, we'll have a look on their website. He looked on the website, and he found that there is actually an instant access deal from First Direct paying 3.5%, which is not a market leader, but it's not far off the market leaders. And he thought, well, you know, being able to just shift stuff across from my account and backwards and forwards, see it all in one place, you know, I'll give up a little bit of rate for that. I'll go try and open it on the app. Couldn't open it on the app. What's going on? So contacted First Direct, was told, no, can't open it on the app, can only do it over the phone. So he tried to do it over the phone, and then got asked 1,000,001 questions that he thought were really quite intrusive for simply opening a savings account and basically handing over lots of information that his bank should already have known about him anyway. So he grumpily decided not to do it. And then he took First Direct's task. And they said, well, yeah, we like to update our information on our customers and so on. And you could open this on the app, but you could do it through the chatbot. He tried to do it through the chatbot. The chatbot didn't work. The chatbot just kept offering him the regular saver that he didn't want, that he could have opened on the app himself anyway. So this is an example of how even trying to open one with your own bank can cause a bit of friction. So then when you go to another bank, you've got the whole, oh, well, I'm going to have to like fill in the forms, and they're going to have to send me a letter with my account details, and then the letter with my login details, and you have to log in and get a this and a that. But it's worth it, because basically it's definitely worth it to not leave your money sitting in an account paying 1% when you could be in an account paying 3.5% to 4%. And I will say that this week I tried this out with one of the new savings providers. It's an app, you know, it's Chip. It's not even a proper bank. It uses somebody else's banking. Remarkably easy to get through. You could get money into an account within 8 minutes, basically. 3.82% paying account within 8 minutes. That's not bad. So sometimes it can be pretty easy. And I've had this experience with some others as well. I've found in the past, Atom particularly easy to deal with, Marcus particularly easy to deal with. So it's not true that with all of them you have to jump through lots of hoops.
Well, that is good to know. Because Helen, I was going to ask you, if you do have your money just sitting around in an insult account, what should you do with it? Where should you move it to? You've got a piece by Ed Magnus about notice accounts. Are they worth a look?
Yeah, so I mean, the first thing to do, and actually I kind of agree with Simon in that banks don't necessarily make it easy to find these accounts. You know, I think they rely on people being a bit in the know and being willing to kind of look up the different rates and not just accept their bog standard easy access account, which I think is a bit unfair, because, you know, they're giving these blanket increase to all their mortgage customers, but as a savings customer, you know, you have to really kind of do your digging to find the best rate, which I think is kind of unfair. But yeah, you do have to do the hard work. So the first thing to do is go to This Is Money. We have independent best buy savings rate tables. So we list everything from your easy access accounts to 1 year fix, 2 year fix, 5 year fix. We update those every day, so you can always see what the best rates on the market are. Notice accounts are an interesting one. So Ed, our savings reporter, has written that there's actually some pretty decent rates on these at the moment. So currently offering interest rates of 3.28% on average. That's compared to 2.27% on easy access. So quite good. Although the thing you have to be aware with those is that you do have to give your bank typically between 30 and 120 days notice when you want to take money out. So it could work for some people, but if you're going to need to dip into that quite regularly, probably not the account for you. I think just generally when sort of opening savings accounts, be really aware of those terms and conditions, because even some accounts that say they're easy access have restrictions. So, for example, they might only let you take out money 2 or 3 times a year. Things like can be sort of quite sneaky. So definitely worth digging into the small print of accounts. But yeah, if you're on an easy access account with a rubbish rate, definitely look around, because there's some good deals to be had out there at the minute.
Simon, with rates as high as they are at the minute for saving, is investing worth it anymore?
Yes, it is, because if you look at almost any study that goes into the very long term, you will discover that investing in the stock market delivers the best chance of a real return on your money, an above inflation return on your money over long periods of time. And the longer you do it for, the less the chance there is that you are going to lose value of your capital over any given period. One of the best reports on this is the Barclays Equity Gilt study. And that one that was released this year shows that once you go to 10 years, over any 10-year period, dating back over about 130 years or so, I don't have this in front of me right now, so I'm paraphrasing, but over any 10-year period, so literally you could start in any one of those years and end 10 years later, the chance of you losing money was like less than 10%, which, you know, when you consider how broad a net that's casting, that's quite a bit. So yes, it is worth investing, but it might be worth looking at some of these returns for a 1-year fix and sticking some money in and going, right, well, you know, a 5.4% guaranteed return over 1 year when things look as uncertain as they do now, that might be worth having. So maybe it's worth taking a chunk of your money and sticking it in there. Now, the problem is obviously you're going to have to pay tax on that. So really you want to try to be getting it into an ISA where you won't be paying tax and the rates on those are lower. But I could, I think honestly, you know, I look at some of these 5% plus rates and I think, well, 5% guaranteed for 1 year, you know, that's not bad, you know, and you know, arguably, yeah, strong chance stock market might beat that. But you know, it might not. So if you're a cautious investor and you're looking at maybe a kind of a more short-term scenario, then maybe it is worth banking some of that kind of 5% over a year kind of thing. I definitely wouldn't do it for 5% over 5 years. I think over 5 years, I'd be thinking, right, the stock market should outperform there.
Right, before I leave you, Simon, I just want to zoom out. That was weird. Your camera just zoomed out just then. How strange is that? I just want to zoom out a little bit and just take a holistic view of what's going on at the moment. And what does this mean for the wider economy? I sense the pips are starting to squeak with the Bank of England interest rate rises, but they're continuing to turn the screw. Will we get a recession? We thought we dodged it. Have we? What does it all mean, Simon?
I'm not sure we're going to dodge this recession, but we might do. There's a possibility we might do. I don't underestimate the sort of power of the UK consumer economy to bat off various things that are thrown at it. But even if we dodge a technical recession, I don't think that for many people we're going to dodge the feeling of a recession. And I think for a lot of people, it feels like a recession already. You know, a recession is when things go downhill for the country's finances. The country's finances are ultimately made up of a lot of people's finances and a lot of businesses' finances. And I think for a lot of people and a lot of businesses, their finances have gone substantially downhill. There are still a number of people sitting on money that they saved up during lockdown, which may not have been exhausted, but they were maybe hoping to build up those savings. And I think actually this is one of my biggest concerns over this in terms of the long-term picture, is I think that there are now generations that are never going to be able to build up the savings and the lifetime wealth that their parents' generation did. If you look at a lot of people, you know, a lot of what would be the kind of boomer generation people, my parents' generation, the generation kind of people 10 years younger than that, and so on. What I've found over the years from working on This Is Money is obviously we've got a wealthier, switched on audience. But I'm often surprised at quite how much money people have managed to build up. Often it's in cash savings, you know, but it's their lifetime wealth they've managed to save, you know, relatively normal. It's not middle income, because middle income is by definition people on the median salary, but it's middle rich income. Over the years, you know, they diligently managed to save up, maybe sometimes invest, you know, often pots of like, you know, a couple of £100,000, and that's on top of any pension that they've got. I just don't see a scenario where people on those same middle rich incomes in their 20s, 30s, 40s are going to manage to build up that lifetime wealth, because there's no money spare. They don't have the money spare over and above, you know, what what they're paying on their mortgages and the bills and everything like that. So I think the longer term picture for the economy is problematic. And we need to find a way to get productivity going again and get the real standard of living rising again. There were figures out showing real wages haven't risen since the financial crisis. That's astonishing. Nobody has got any richer since 2008 on average. There are people who have obviously got richer, but nobody has got richer in inflation adjusted terms on average in this country since 2008. And that's just absolutely astonishing. But I think that the answer is there. We can do it, but it requires a real kind of plan and following through the plan, not the repeated plans that we come up with and never follow through on. And I think that requires leadership. And I don't know where that leadership is going to come from or who it's going to come from. I actually couldn't care less where it comes from. I have no political affiliation whatsoever, but I would like to see a little bit of it coming through and getting things going. But we were at the point of peak pessimism. It wasn't that long ago we were talking about the recovery from COVID and the roaring 20s. Maybe we'll still get the roaring 20s. We're just getting the painful readjustment first, which isn't as good a slogan as the roaring 20s, I will admit.
The painful readjustment first. No, but I like the optimism, the tone to end it on. That's it for this week. You can keep up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions to the team or anything you'd like them to look into, Simon.
You can email us at editor@thisismoney.co.uk. You can tweet us at thisismoney, or you can come to thisismoney.co.uk/podcast to find all podcast paths and join in the debate and read the comments.
And if you like our podcast, why not rate us wherever you found us? It helps other people find us too.
Don't forget, you can stay on top of what's going on in the markets by tuning in to the Digest and Invest podcast by eToro. Go to your regular podcast platform and listen on the go. Digest and Invest by eToro, the podcast for those interested in trading and investing.